share our screen. Good morning. We are live on Facebook and Twitter with Carlos the Great and Michael Lowman, the lender to the stars. That's what I call you. He's a lender to the stars.
That's right. Starting
Good
with
morning.
you.
Good morning. How you doing?
I'm doing
Good,
great,
good.
man. Thank you.
Good, good. I got your website pulled up, and I'm glad you could join us this morning. I'm so glad to have you, my brother. We've worked together for quite a few days, and so I'm glad to have you on the Follow-Up Friday, so we can kind of talk a little bit about the many things that you can do as a lender in this real estate and investment space. It's kind of mind-boggling. I was thinking about Colin and some of the things you're working on for him. And I was like, this guy's like a lender to the stars. That's kind of what I'm gonna call him now, lender to the stars.
I love it. Thank you. And
Yeah,
funny thing is, I didn't even realize that was my site. I'm like, wow, that's a nice site.
yeah, it's really it's a great looking site. Yes, this is easyinvestmentcapital.com, and I'll put this on the banner so that people can we'll just run it and stream it across the bottom. So, but yeah, Mike, you want to start off by just introducing yourself? Tell us a little bit about who you are, what you do, and then we'll kind of jump in from there because I think it's good to kind of have you start off like that.
Sure. Thank you. So my name is Michael Lowman. I have a strong focus on mindset because if you get your mind right, your money will be right. So when it comes to this lending world, Steve, I have a lot of options. I can have a lot of fun. I can, interject a lot of creativity into the acquisition process or whatever it is that the investor is looking to do. So what I focus on is what they call non-QM or non-qualified mortgages. These are mortgages that are not regulated by Fannie or Freddie, right? So they have slightly different rules, typically a lower barrier to entry because I'm not asking for things such as tax returns, W-2s. I'm not really looking at the DTI of an individual. I'm looking at the asset, does the asset debt service, where's your credit? And I have programs for people in all credit tiers, and I have a team of people that can actually help you to raise that credit score. And yeah, I'm a creative person, so I just love to have the freedom to kind of put things together.
Yeah, you mentioned one of the things you mentioned when you were just kind of describing what you did, who you are and what you did. You talked about the why individual income might not matter as much in the type of lending that you do for investment properties and things of that nature. I think that's a good place to start. How maybe talk a little bit more in terms of how you differ from what I do as a residential lender compared to what you do when you're trying to get people into investment properties and things of that nature, and how you calculate the income and how that differentiates you from what I could do.
Perfect. So yourself as a residential mortgage lender, you're looking at the individual heavily. So you're looking at, you want to see tax returns, 2 years. You want to see their debt to income, meaning the money that they're bringing in versus going out. Is that a certain percentage? And I'm looking at the
Did we lose Mike?
no,
Still there?
yeah,
Okay.
probably because I received a call. So, can you still hear me?
Yeah,
Yeah, we can hear you.
You cut
Okay,
off on
great.
I'm looking at, and that's where you kind of cut off.
Okay, so I'm looking at the asset. I'm not really looking at the individual as much as a residential mortgage lender. So I'm looking at the asset. Does the asset debt service? And what I mean by debt service is the amount of money coming in greater than the amount going out. So, and I'm only looking at maybe a 1.1. So if if the mortgage is $1,000, I'm looking to make sure that the property is making at least $1,100 a month, and that's something that I would be able to consider as just as a commercial or an asset-based lender.
So you're saying that you're talking about debt service, and this is something that a lot of people don't know much about. And you just said a 1.1. So you're saying that if the mortgage is 1,000 and the rental income is 1,100, that is a 1-to-1 or 100 and what is it? 110% debt ratio, debt service coverage ratio.
That's correct.
Okay. And then that would be a doable deal because the rental income covers the actual mortgage service debt.
Absolutely. I couldn't have said it better myself.
Okay. 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 Good. Because a lot of people they're not very familiar with the whole DSCR thing. Carlos,
Hmm.
wouldn't you say a lot of people are not familiar with that?
Yeah, there could be a whole class of a lot of people in it that can learn about that.
Mm.
Mike,
Okay, Carlos.
why is that? Why is that a metric? I mean, obviously, it's a better metric to use for investment property, but why is that such a metric that's used in your space? And of course, it's a positive thing. But why is that used in that space? For people out there thinking about maybe investing and getting some investment funding.
Well, contrary to what most people believe, the banks actually want to get the money out. Like no one's is the money is doing no one any good just sitting there. So we want to actually get the money out contrary to what people think. So I work directly with investors. So if you're looking to buy a primary home, I'm not your guy. Steve's your guy. But if you're looking to do a investment property and you're looking to add some creativity to it, then that's where I step in.
Awesome, awesome. So I think that is something that's a good differentiation. The banks want to give money out. They're looking for opportunities to lend money out, particularly with investment properties. And you know,
Absolutely.
yeah, no, that's good. That's good. So I don't have to. So then for me, who if I'm interested in getting a loan with you, what's the first starting point, and what's the minimum ticket to the dance? Because we have minimum tickets to the dance. We have a lot
Right.
of tickets to the dance. What are
Yeah.
your
So
tickets to the dance, Mike?
right. So Steve, I'm gonna tell you, minimum loan amount is different all across the board. So if I'm, and that's the good thing about me being a broker with private funds is that we have the flexibility. So there may be one bank, $100,000 is their minimum. I know unless the deal is 130, and you experienced that with me with one of the banks, right?
Mm-hmm. Yep.
So
Yep.
unless the minimum loan amount is 100,000, then there's nothing I can do. Also, I have some lenders that will do a minimum of 50,000. You just have to understand that if it's a short-term loan, bridge, or what they call fix and flip or fix and hold, I'm usually able to get a person in that deal for like 10 to 15%. 15% if you're a brand new investor, because that's an awful lot of risk when you're dealing with a brand new investor. So 15% on a short-term bridge loan or fix and flip is very good. Now, if it's a straight up purchase, we're looking at 25%, but there's ways to get around having to bring that full 25%. We can do a seller's assist, have the seller do a seller's assist, have the seller do a holdback partial or part of the mortgage. So there's a few different ways that we can actually get an investor into a deal with minimum out of pocket as possible.
Awesome, awesome. So let's unpack a little bit of that because you said a lot in a little. The credit scores It just matters depending on the investors that you might be using, right? Um,
Well, the credit scores. So each bank has a. I want to say, if you want to kind of ride semi comfortably, we're probably looking at 660 and above.
okay.
But anything under that, I have products for that as well. You just have to understand that right from the start, you will receive a higher interest rate. However, Steve, we've talked about this, and true investors who understand math and understand how to attack that amortization chart, when we see higher interest rates, we get excited because we understand it's actually easier to pay off the loan with a higher interest rate than it is a lower interest rate.
Yeah, yeah, absolutely. Yeah, yeah. Most people don't understand the amortization schedule, and that's because most lenders don't go through it. Title
Right.
companies never go through it. So how
You know
would
what?
most?
You know what I've learned? I've learned that Wall Street forbids the banks to even teach this to their loan officers so they can have plausible deniability if someone like us come along and someone finds out and they go to their bank and say, hey, Bank of America, why didn't you ever tell me that I could attack this amortization chart and aggressively buy up this equity and eradicate hundreds of thousands of dollars in interest payments? Why didn't you tell me? They're going to say I didn't know, and they won't know.
Because they never were told how to do it. Yeah, yeah,
Nope.
yeah. So we cover that. I cover that in. Go ahead, Carlos. Go ahead, Carlos.
So let's do a class.
Yes, yes.
Carlos, I love the way you think, man. We have to do it. Ever since you said that, my little ears perked right up. We have to do it.
Because I mean, seriously, I work with investors. I work with people. And there's people out there. Like I have a client right now that wants to buy a house, but really he wants to buy an investment.
Mm-hmm.
And he doesn't know anything about that.
Yeah.
Wow. Yeah,
Let's have a class
let's do it.
talking about these two keys.
Yeah, they're so pertinent, right? Like even with if you take, I'm not looking at tax returns. So if you're an entrepreneur out there or you're 1099, think about this. We're told we can write off a certain amount of expenses on our taxes. So we do everything we can to get the write-offs that they say we can have, but then you go to the banks and the banks say you're not showing enough revenue. So you're kind of like, hold on. It seems like a catch-22. I'm able to legally write these things off, but then on this side, I'm not showing enough revenue. So just by the mere fact that I take tax returns off the table, I give a bigger, broader group of investors opportunity to actually begin to build that wealth through the investment.
And that's me. You know what I mean? I'll just tell you right now, I got other businesses. I got a lot of businesses that make money, but I have the certain write-offs. You know what I mean?
Mm-hmm.
So,
See,
I mean,
exactly.
I'm at that point where I make good money, but
On
somebody will,
paper.
Uncle Sam will take my money, so you got your correct write-offs, and it
Mm-hmm.
kind of sometimes it affects you.
Mm-hmm. Absolutely, and that's the catch-22, right? They tell you can do this, and legally you can do it, but when you want to go to the bank to get leverage, and it's funny because Jay-Z said they'll give you debt, but they'll never give you leverage. So when you go to get leverage, which means I'm not going for a mortgage on a house, but I'm going to get leverage because I'm looking for cash for an investment property that's an asset that's going to bring me passive income. Now you're not showing enough revenue. So I take that issue off the table right from the start.
Yeah, leverage is important. Understanding leverage is important. Understanding that the wealthy use their assets and leverage them to buy more assets is even more important. And that's why it's important to have assets and not be sitting at home renting a property. Um, and have nothing to go tap into. Think about all the people who tapped into their home and the equity of their home when the rates dropped, right? I mean, about all the people that tapped into their equity. And that's why it's so important to have a greater scope, a greater view of things. Real quick before we move on, I wanted to just, and this is again, Carlos, something we definitely can do more in detail, but I have on the screen the amortization schedule, right? Everybody gets one of these in their packet when they get a mortgage. Very few people go over this with them, but essentially what you're looking at here is you're looking at what your total principal and interest payment is, what your total, and this is on an annual basis, right? What your annual total principal is. So for the year, you'd be paying $11,531. Your principal of that is 4717. Your interest for the year would be 6781, right? So it's almost $2,000 more than your principal. And then cumulative interest, cumulative principal paid versus your cumulative interest paid. So what does this mean? What this means is that if you started your mortgage today and you decided, hey, I'm going to prepay this principal, this column right here, I'm going to prepay this, right? If I prepay this, most people don't understand. If you pay 4717 in advance, you don't have to pay 6781 at all.
Right. See, that's mind blowing to people. They don't get it. Just by paying that extra principal during the month, you completely wipe away that next line of interest, and you're not capped there. You can pay as much as you're able. Let's say you did, you some type of windfall or whatever, I don't know, and you were able to pay up 5 of those months. Well, you're looking at, that 6 number times 5 disappearing. And that's really adding massive equity to your opportunity. And this works whether it's an investment property or a residential mortgage. So some of you homeowners out there, my suggestion to you would be to pull out your amortization chart, get it laminated, and actually begin a plan to attack it. Because even if you can't pay the full principal amount, anything that you put towards it is going to, let's say for every $1, you're going to wipe away $4 from interest level.
So
go ahead, Carlos.
So if you pay $50 a month, or if you pay $100 extra a month, or pay $100 extra every payment, that should knock off a lot of that, right?
Yeah, absolutely. Absolutely.
So Carlos, and maybe I should change the screen, because this is showing annual, and I don't think that has the same effect as understanding the
monthly.
Yeah. So let me change and pull up a monthly view of this, so that we can kind of talk to it on a monthly basis. And again, I think this is it right here.
Yeah, and you're talking lamination and those things. Do you know how many pages those things are?
It's like eight.
Yeah. So here goes a monthly view. So here's a monthly view. So this is monthly. So you got your payment, which is $954, your interest, which is $666, and your principal is $288. So $288 is going towards the $954. So that's saying
wow.
if you paid this principal, you could get away from doing this in general, right?
That's wild. Isn't that wild?
Crazy, right? So that means, Carlos, if you took and say right now you're paying $954 a month, and this is how it's being split. So say you have to keep making your monthly payment, but let's say you said, okay, well, I'm going to take an extra $50 a week or whatever, $60 a week, so that I can prepay for next month's principal, and it will eliminate this $665. So now all of a sudden you're really now $665 to the good, because you don't have to pay interest. Now you continue to make your monthly payment, but you basically are prepaying the principal, and that principal is eliminating this column entirely.
What does that knock off?
Look at the number here, right? You're talking about interest. With interest, typically you pay 3 times the price of the house over 30 years. So usually when you look at the interest added onto a loan, you're usually paying 3 times the cost of a house. It's
So if it's
probably
$100,000,
you're
so if
paying,
it's $100,000, you're paying $300,000 at the
yeah,
end of the 30
Yeah,
years.
absolutely. Because if you take a look at it, so if I do, I don't know, 100,000 and I say 9% interest and I calculate that, you really have to multiply that times 30. So it's like you're paying 30 mortgages.
yeah, yeah. And the first time I saw this is when I bought my house, and I looked at and they showed me this, and I thought, whoa, okay, wait a minute, why is that so much? Well, that's interest. That's
Mm-hmm.
interest. That is called interest. And you can either use it or you can let it use you. You see what I'm saying? You
Come
know,
on, man.
you
That's
can
good.
use it and let it use you. And so understanding that you have the opportunity to attack, Mike and I would call it attacking the amortization schedule.
Right.
It essentially doesn't matter what your interest rate is. You understand that
Right.
you can attack this. It doesn't matter what your interest rate is.
And I
Doesn't.
have to keep driving this home. The higher, can you explain a little bit why the higher the interest rate, the easier it is to pay off, or do you want me to explain that?
You can explain it, but before you do that, let me just show just to follow up with what I was just saying about the 3 times, 4 times, whatever, right? So look at this right here. Can you guys see this screen right here? So this
Yes.
is a CD. This is a real life CD right now. Like this is a real life CD. Like this person is buying this house, and I believe this house is for like I believe it's like 3 or 400,000. Let me just confirm, because I don't want to tell any falsehoods here. But I believe the purchase price of this house is 430. Okay, 430. So after all of the interest, this person will be paying $1.1 million for a $430,000 house.
Mm.
3 times. 3 times. That's and look at it right here. The finance charge is almost 700,000, and they're financing 408,000.
My God.
Power of compound interest. You can either use it or it will use you. And the way you use it, Mike, I'll let you go ahead and talk now a little bit about that. But the way you use it is you attack the amortization schedule. Go ahead, Mike.
Wow, Steve, that was very beautiful, man, and really eye-opening. And it's very, very simple. It's very simple.
What are you talking
The
about?
higher,
Beautiful. It was ugly.
yo, it's funny, man. Me and Steve think we're brothers. Um, the the point, and it's very simple. The higher the interest rate, the lower the principal payment. So if I have a 10% interest rate, and we're just say, let's take a round number of $1,000. Well, $300 may be going to principal, and then 700 of those dollars is actually going to interest. So if I'm able to put another $300 on that during the month, I totally wipe away another $700 in total interest. Now, don't make the mistake, when that next month come around, you're still going to have to pay your full payment. However, on the totality of the loan, that $700 that you would have paid goes away. And the more you're able to put down, the more of that interest payment you're looking to wipe away. Actually, the gentleman who taught this to me, he has students who have paid off houses in 7 to 9 years using this strategy. 30-year mortgages paid off in 7 to 9 years. 15 if you're just, you're not being aggressive about it. But hundreds of thousands of dollars saved that can be going into whatever. Plus, when you do this, you actually force equity into the property on a quicker scale, so that you can actually do a cash out, which is tax free because it's debt. So when you do a cash out refi, that's why Steve, when I have people tell me they're looking to do a fix and flip, I try to discourage fixing and flipping right now, because if you fix the property, you raise the equity, you flip it, you let's say you make, I'm gonna get crazy. Let's say you make $100,000 on a flip,
Right.
right? But now you have capital gains tax, which is almost what, 30, maybe 40% of that.
Yeah.
So now, so you don't actually get 100,000. You may walk away with 50 after it's all said and done, closing costs, so forth and so on. However, when you do, if you have you know, if you have the ability, let's say you have $100,000 in equity, $75,000 in equity, you can do a cash out refinance on the equity and receive a check for the full amount and not be taxed on it.
Mm, mm. You might want to say that again, Mike, just a little slower for those people who don't know.
So if you have a property and you have equity in your property, and let's say you fix the place up and you say, I'm going to go sell. Well, selling isn't the best thing, because you're looking for that profit, but you're not going to have it because you have taxes. You have capital gains taxes on a sell. But if you do a cash out refinance, all that money comes to you tax free. You actually don't even have to bring anything to the closing table, because any fees or any fees that you have is going to come out of the equity. So you're able to cash out and then take that lump sum and put it directly into another asset that's going to produce passive cash flow, and that's what you spend. You spend the passive cash flow.
Yes. So Mike, so you've already blown 95% of the people's minds here. One, how easy it is to get into investment property and acquire assets with some different lending options. Two, the whole passive income. Three, the tax reductions. Four, you've already just talked a little bit about the attacking the amortization schedule. I mean, you've already knocked out 95% of the people's basic knowledge and help them get to another level. If they just follow those 3 or 4 things, you already have provided them with some tools that they probably never even knew.
Yeah, man, absolutely. I love it. It's when you come from a certain place, Steve, and you find out certain information, all you want to do is share it. And it's not like it's secret, but it's not like it's broadcasted.
Yeah, absolutely.
so they can tell you, oh, this is not a secret. See, here it is right here in section 8, V16, verse 3, in tiny little print right here. It's right there. Right. So if you get to the point where you can figure that out, now I just want to help people.
Yeah. Well, the details are always where the greatest amount of information resides, and unfortunately, most of us are headline readers. You know what I mean? We're ticker symbol readers. We read the ticker. You know what I mean? Or we read the headlines, and it's the little stuff and the little print in between those two that make the biggest difference. And like the amortization schedule, like the debt service coverage ratio. So I have that. I want to spin back to that real quick, because what I have an example. You were talking about debt service coverage ratio, and I think again we're dealing with a visual population. So I like to provide visual for those visuals, right? So I want to pull up a rent roll, because that's what you use, right? Mike, talk a little bit about what you're going to use to determine exactly what the debt service coverage ratio is. Like, what do you use? And while I'm pulling this up, talk a little bit about that.
So we have to look at the name, debt service coverage ratio. So the ratio of coverage between the debt service and what's actually coming in. So that's why I said, if the mortgage is 1,000 and we're looking at, and the property is guaranteed to bring in 1,100, we consider that debt servicing at a 1.1. So the thing that's very interesting about debt service coverage ratios is that if your credit score is shaky, or if you don't have, you don't have all the financing. Oh, also, Steve, as you found out, my man, there's no seasoning.
Correct. Correct. There's
There's
no.
no
I mean,
there's no
the money
seasoning on our
doesn't have
money.
to. The money does not have to sit in the bank account for X number of days or X number of months.
What did we it was to the point when it got, listen guys, it got so crazy on one deal. Steve was like, "What are they gonna ask for the bank account?" I
I
said,
did.
Steve, Steve, don't worry about it. If they not asking, we're not asking.
Right.
And
Right.
and only one person asked, and that was like the day of closing.
The day of closing. Yeah. Here it actually wasn't even asked. It was, here goes where you wire the money to. Give that to your person. You know. But on the screen here, Mike, I have in here, like, here's the total for the rent, right? So that's the $5,100 a month. The debt service, the monthly, this would be the monthly payment, right? The monthly mortgage payment, the debt service, right? Uh,
Yes.
is monthly mortgage payment is below it, and that's 3,000, right? And then what you're doing is you're basically dividing this, which is the rent rolls, divided by the debt service to come up with the debt service ratio, the DSCR ratio, which in this case would be a 1.7.
Oh my God, this is a great deal.
Yeah.
This
Yeah.
is a great deal, especially if it's what kind of property is this? This a multifamily right here?
Multifamily, yeah, this is a multifamily property. Yep. 6-unit multifamily property.
Oh man, yeah, that's a great deal.
Yeah, and we Carlos, we definitely got to dig more into this, because here's the other thing, right? Here's the other thing, right? Which most people don't pay any attention to, Mike. Depreciation, right? Depending on the cost of that property and so on and so forth, you can depreciate it off. You might depreciate this property off, I don't know, 10, 15, 20,000, whatever, a year, right? So that could potentially be, maybe another $1,000 or $2,000 a month of depreciation that you write off, reducing your taxes on your asset that you own, right? So you have the debt service ratio, but then also once it gets to tax time, you have depreciation, which is a write-off, which will help you reduce and keep more money in your pocket. Again, the importance of understanding assets, real estate and assets, as opposed to just sitting and paying rent. I think we lost Mike. Mike, you there?
Yes, I've mastered this finance. It's just the phone that I have an issue with.
Oh, that's okay. Yeah. That's okay. That's okay. I was just talking about the depreciation as well, and how important that is as well. As far as
Another
understanding,
write-off.
yeah, another write-off, and understanding how you might evaluate or look at a property. A lot of times, people will just look at the current rents, and they'll say, "Well, I don't think that's enough." And it's like, well, okay, well, there's a lot more to a property and evaluating an investment property than just the current rent. First of all, that's the current rent. That doesn't mean that is the market rent. That doesn't mean that's what
So true.
you can rent it for. It also doesn't mean that you can't take advantage of the depreciation, because that, to me, is the biggest winners. That's why a lot of wealthy people have real estate, because
Right.
the tax write-offs, depreciation is one of the biggest tax write-offs that you can actually get.
Wow, that's true. Um, just to have that alone, people say the market, the market is this or the market is that. First off, I just want to let people know that the market is within, not without. The market is within. So whatever your narrative is going to be is what going to be for you. Now you have the ability to choose your own narrative, or you have the ability to be swept up with the narrative of the collective consciousness. Is going to be your decision.
Yeah, that's well said. The market is within; it's not without. Yeah, you're right. I mean, that's why in this type of market, and Carlos knows this because he's got a lot of. Carlos focuses a lot on commercial. Like, he came in, got his license, and quickly understood commercials is space for me, right, Carlos?
Mm-hmm.
Yeah, it is, and I love it because it's if it makes sense, it people do business.
That's right.
I love the business aspect of real estate. Um, Obviously I like residential too, but I love commercial just for the business aspect of it. Making the money, the numbers, trying to figure out, if it makes sense. What can people profit off it? I love that part of the commercial.
Yeah, same here. Same here, Carlos.
Yeah, it's good stuff. Mike, talk a little bit about the bridging loans. I'm going through your site. Most people again don't really know what a bridge loan is. Can you talk a little bit about that and what it is?
Yes, absolutely. So most people would know this as what they call hard money loans. So they're short-term loans. What I mean by short-term, it can be 6, 12, 18 months. It all depends on how long it's going to take you to actually acquire the property, do the renovations, and be ready to cash out or refinance out of a short-term loan. Now, with most hard money lenders, you're looking at 12% interest right from the start. And this is before the market even started to shift with the raising of interest rates. You they would start at 12%. Some go up to 18%. I have the same product, and because my funds, I'm dealing with private lenders who specialize in getting money into realtors' hands, I can be floating anywhere between like 8 and maybe 11%. And that 11% is a monthly interest payment that you would be paying on the on the total that you buy. So on a bridge loan, it's usually I see a property, I want to buy the property needs work. I don't have the money to actually put into the renovation. So I would loan you 90 to 85%, 85 to 90% of the purchase price, plus give you 100% of the funds to actually do the renovation, because I've already done the numbers and I realized that yes, the property right now is 150, it needs 50, but the ARV or the after repair value or the comps are 275. So I know that I'll be able to do, I know that this client, if they do everything the way they said they're going to do, will be able to cash out and pay me back and still not equity strip the property. So they'll be able to pay me back and begin to rebuild their wealth, having someone else pay down that mortgage. I hope that was clear.
Yeah, no, for sure. I mean, I think the key is the fact that it's a short-term solution, right? To help you acquire the asset, do what needs to be done in order to, pay off or get out of that bridge situation from the equity of the property and the improvements that you do while you've got it, essentially, right?
Yeah, absolutely. And I have people come to me all the time. They either find the worst property or they find the best property. I say do like the three little bears. Find the one in the middle. Find the one that's just right. Simply because, not even from a standpoint of the amount of work that goes into actually renovating a property, but it lowers your barrier to entry when you actually have to put work into a property. Because if you come to me and you have a property that's just is retail, is ready to go, then that's going to be 25%, and 25% needs to be brought to the table. However that's split up. But however, if you find a property that needs some work, you can get into the deal for the 10, maybe 15%, get the money to fix it up, and then do a cash out refi in a few months. So to me, that's just like the perfect storm.
Right. Pick the one in the middle. I love it. I love
Right.
it. Carlos, questions on that? Any questions on that for Michael at all from you?
No, like you said, the only thing is like the time right now is to not necessarily fix and flip, but it's a good time to fix, and you could do that same thing with fix and hold, right?
Absolutely. The time now is to fix and hold for all those reasons we spoke about. And I almost guarantee you that a lot of these guys that's talking about fixing and flipping, man, aren't paying their taxes. And that's a big thing we want to talk about. We don't want to not pay these taxes because ultimately they knock on your door when you least expect it. So when you have a situation like that, you want to hedge yourself as much as you can. So fixing and holding does a couple of things. Number one, it gives you that depreciation factor. Number two, it gives you the ability to get a quick lump sum of cash tax free.
I love that tax free.
Tax
Yeah,
free.
right. Tax free. That's how we, all right, what can I, so tax, you don't pay taxes on debt. And this is the biggest thing that we don't understand, especially Steve, culturally in our community, you always hear get out of debt, get out of debt. Debt is bad, right? Debt is evil. I was I don't know. Remember, I don't know if anybody ever seen Dark Knight Rises with Bane. He told Batman, he said, "You merely adopted the dark. I was born in it, molded by it." He said, "I didn't see the light before I was already a man, and by then it was only blinding." By the time I heard the term good debt, I was already a man. And I could not believe that those two words were going together. I was in my 30s when I heard the word good debt.
Yeah, 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 yeah. And you were younger than I was, so
Wow.
don't feel bad,
Wow.
Yeah, I mean, debt you can write off, right? Debt you can leverage. Yeah, but
Absolutely.
again, that's
Debt is leverage.
debt is leverage. Yeah, yeah. But a lot of that has to do with the fact that we just don't know, like you just said. Like,
Income producing debt though.
yeah, yeah, yep. And where do you learn that? You don't learn that in school. They don't teach that
No.
in wood shop class. You know what I'm saying? Don't learn that stuff at all. So, which is why it's important for us in the real estate and financing world to to do our due diligence to help people understand that there's opportunities to learn some things you probably wouldn't learn in school or in college at all.
But they learn at our events that we put on.
They do.
Absolutely. They definitely do.
They do. They do. So we definitely have to do that. You're right about that, Carlos. We have to do that.
Carlos is the man.
Carlos is. CC Hustle. We call him CC Hustle.
I can hear it, man. I need that type of energy.
So Mike, we've done some creative deals in the past. You talked about it a little bit earlier in your intro. If I want to get into a property and I may not have enough money, how can the seller help me get to the table with less to purchase an investment property?
Well, standard, there's your standard seller's assist. Some banks allow more than others. Some banks allow the seller to carry a second note. Or Steve, you can bring in a partner, and that partner can provide what they call gift funds. You were involved in a deal like that, right?
Yes. Yeah.
You were involved gift funds, and we did a great job on that appraisal, huh?
That's right. Yeah. Yeah. Well, and there's like, with the appraisal, again, this is the investment world. This is investment property. So, so the seller's limited in my world as to what they can assist with. They can't help with down payment in my world of residential lending. They can only help with closing costs. In your world, the seller can actually help with down payment. So
that's right.
So we have a property that somebody wants to buy and they only have 10% or whatever the case may be, where the seller can assist and give some of their equity from the sale to the buyer, and help them come to the table with less money to put them in a position to be able to get into that investment property. Unheard of in the residential world. Unheard of in the residential.
Absolutely.
And they can get gifted the other 10%. So if they got a rich aunt or uncle in Florida and they want to contribute to that investment purchase, they can even get the other 10% gifted from someone else without even having to source the funds.
That's right, because there's no, so for certain banks in this non-QM space, there's no seasoning on the money. So as you can see, and even as I speak, residential properties are liabilities, right? No one wants to call it what it is. A liability is something that takes money out of your pocket. I'm sorry, yeah, liability takes money out of your pocket. An asset adds to your bottom line. So if you could just take a look at your life, you can just ask yourself, where are the liabilities and where are the assets in my life? But just as everything else, it's hard. They want to make it harder on a person that's purchasing liabilities. They really do. If you take a look at it, people who focus on purchasing liabilities have the toughest time. And it's meant to be that way because the powers that be that set this whole thing up understand that if a person is not purchasing assets, then they don't know. And so all the millions and billions and trillions of dollars that are made in the world are made off the poor and the ignorant.
Mm-hmm. Mm-hmm.
And I hate to say it, but it's the truth.
Well, that's what capitalism is all about. One capitalizing on the other. And it's our purpose to maybe help people, realize they can get a greater piece of the pie. You don't.
Yes.
I had a conversation with a friend of mine just yesterday. And I said, listen, I want to take down a $3 million project. And she said, man, that's a little bit bigger than what I think I'm able to do. And I said, why? Like, why is it bigger? Right. Why do you think it's bigger than what you're able to do when I don't think it's bigger than what I'm able to do? The only difference, is your limiting belief. That's it. Like, why is it too big of a project? Like, you know what I mean, Carlos? I mean, think about it. Like, why? Like Carlos, you left and started and came to Kansas City and started fresh, brand new with nothing. But you had no limiting beliefs, right?
I can go anywhere. And you know what? That was the hardest thing. Don't get me wrong. I worried about it, or I wondered, I'm like, what do I do? But then I thought, okay, I could do this. It's the same thing. Start from the basics and you work your way up. But yes, it is. If you limit yourself, and then you're gonna be limited.
That's why
you gotta. It drives me crazy when people, that limit themselves. And I hear it, and it's just like, you can't do that. You can't stop there. You got to keep thinking more. You can do it. I mean, I started from scratch, and you can do it. I could go anywhere now. When I'm ready to go to Florida, I'm just going to go to Florida, and then I'm going to start all over. I'm going to build that up down there, and then I'm going to live back and forth. So I could go anywhere and start building a business.
Carlos, how long have you been in Kansas City?
Since 2010. So
12 years now?
12 years.
How many businesses do you own? Did you start from scratch with when you walked into Kansas City?
3, 4.
4.
3 because
brokerage, right? The brokerage, right? Yeah. You got the photo booth, right? Real estate, yeah.
Printing, mail and copy,
yeah. So you started from scratch with 0, and that's because I know you because I've been working with you, and Mike, same way. You don't have any limits. You think big. So that's like people. We need to think bigger. Like, we need to think bigger. We can't let fear drive us. We can't let higher interest rates drive us. We need to understand that somebody's buying investment property right now.
Those interest rates. I keep telling, I tell my people here, they're like, interest rates are going higher. They're higher. Who cares? I said, they were higher when I said I paid 10% interest for my house, 9.775 or something like that. Who cares?
Carlos,
Shift your way, shift it, do something different. We work with investors here. We like investors here. We like businesses. Shift your way and figure out, maybe start working with investors. If you feel that there's buyers out there, or sellers are going to sell, but if there's buyers out there that they're scared of the interest rate, let them know that there was higher interest rates, for one. For two, there's ways of getting a little bit lower interest rate. For three, who cares? You know what I mean? You still got to buy a house. People still got to live in a house. There'll be somebody out there buying a house, or there'll be somebody out there investing. Shift to investments. You know what I mean? Who cares?
Carlos,
stop with the what?
You want to write a book with me and Steve called Shift Your Way?
I like it. I like it. Shift your way. I like that.
I love it. I mean, and I got to ask you guys. So this lending right here. So I have another client that, they want to buy a piece of land. They have their eye on a piece of land, and they want to build 18 duplexes. Is this something that you can help out with? Is this something that works for them?
Absolutely. Do they have building experience already?
No.
So someone who actually has that experience just needs to be on the LLC.
Okay.
And that's something that we can do all day long. But when you're talking about ground up construction, they want you to have someone who has actually been responsible for paying that loan back. That's what they consider experience.
But do they have to have an experience in the construction part of it?
Yeah, they want, so if a person, let's say you're coming to me, you want to do ground up construction, I'm asking, do you have any prior experience? Is this your first? Do you have any prior experience? And if you say, no, I don't have any prior experience, then my question to you is, well, who in your network actually does? And then they would just need to be on the operating agreement of your LLC.
Okay.
Yeah, it's if you think about it, it only makes sense that they have to have some experience, because why would I want to give you money to do something that you're going to try?
Yeah, ground up.
Mm-hmm. Yeah. I mean, it makes sense. Totally makes sense that you have to have that. But yeah, no, Carlos, I like what you were saying in terms of, shift your way, find your way through, and that is there's obviously, I work with a lot of realtors. You run an office, Mike. You do loans and stuff like that, and so there's a lot of realtors who are slower right now. And the first question I ask them is, are you working with investors? Because this is the time. If you're not working with investors as a realtor, you should be working with investors, because they are still buying, they are still financing, they are still doing deals when everyone is in fear. I think Warren Buffett says, when there's blood on the streets, when do you buy, Warren? When there's blood on the streets, when everyone is fearful, that's when I'm buying.
And not only that, but it's like, that's just like cars. You see cars out on the street, it's just like when the gas prices have been at its highest right now, I think, for me, what I've seen. So I think it's at its highest, but people are still selling cars. You know what I mean? People are still buying cars, so who cares? You got to just shift your business. You got to just do it differently. Just like if it's a selling market and it goes to a buying, you got to shift. You got to just shift with the interest rate. You got to shift with, you just got to shift your business. Go to investors. Find investors. People want to invest in business. People need to invest in real estate. Educate people to invest in real estate.
Go ahead, Mike.
No, I'm daydreaming on Shift Your Way.
No, but that's what movers and shakers do. You know what I mean? Like you can't stay still. Like if obstacles pop up, Mike, you talked about obstacles are within, right? They're not without, they're within. But when
Right.
obstacles pop up, you have to shift. You got to change lanes. You got to go a different direction, and you can't just stay there in harbor in the same place. And again, I have had conversations with with a lot of my realtor partners right now and saying, hey, business is slow. Get some investors. Like investors are always good to work with in good and in bad markets. Always.
Absolutely. Absolutely. Become a solution provider. Bring solutions, bring deals to investors, and you won't even notice that business is slow.
Yeah, absolutely. Yeah, it's
There
kind
was
of
a
go ahead, Mike.
there was a story, and the funny thing about it, I met a guy back in May at a conference, and he was telling me how bad the economy was going to be, and I was like, no, I don't think so. And he went on to tell me about, well, the person who told him, they were from Harvard, and I just when he said that, I just was like, okay. And it's this story that it was this man. He owned a hot dog cart, and he worked really really hard. He had about 30 hot dog carts. Like this guy just made the absolute best hot dog. But his son, who was a Harvard economic major, told him how bad the economy was going to be and how bad the economy was. And so he's thinking, oh wow, so my son, he goes to Harvard, he studied economics, the economy must be bad. Before you know it, he went from 30 hot dog carts to, you know what, let me just change the ingredient a little bit because the economy is so bad. I need to make a shift. He started making that shift. He went from 30 hot dog carts down to one. And then he said, after he got down to one, he said to his son, wow, I guess that economy was as bad as you said it was.
Oh,
Hmm.
it's
Yeah.
yeah, it's fear.
Mm-hmm. Mm-hmm.
Right. So if I started off, I said I help people get their minds right so they can get their money right. So if you want to really start talking about, you're talking about fear, it's a matter of fear, but it's also a matter of self-image. What is, like that woman said, I can't see myself doing a deal, quote unquote, that big. She's only talking about $3 million.
Right.
But
Right.
to her it was astronomical because that's how she sees herself. That's her self-image. And you
Mm-hmm.
can never outperform your self-image. So the first thing I would invite anyone to do is to truly sit down with yourself and say, what do I think about myself as it pertains to this? And not with ego, but truth. Because once you do it with truth, that's why I said the truth will set you free. Because once you sit down with truth to figure out what exactly do I feel about myself and why, you can start to build a new image and a new identity. And, I will be doing a course called How to Step into a Seven-Figure Identity, because that's all it is. Money is just simply the manifestation of the way you feel about yourself.
Mm-hmm. Mm-hmm.
Investments,
I agree.
whatever.
I agree. No, I agree completely. Yeah, the limiting beliefs are challenging, and that's the greatest thing. Shift that shift. Again, the shift is so important.
I'll take mindset in the book.
Yeah, yeah, yeah,
So
yeah, yeah.
Carlos could talk about creative things to do in the market. I really see, like, we should just all take like 3 chapters. It doesn't have to be a novel. 3 chapters. You have 9 chapters in a book to teach people how to shift their way through
Yeah.
any economy or shift their way through any market trend.
Yeah,
I just
anything.
Yeah, it's amazing. We can do a whole series of shift your way. It doesn't even have to be one book. It can be 10 books.
And my biggest thing is it's just like anything. It's in business, period. Steve and I, we do real estate. We talk about real estate, but we also talk about just helping people with business
Yeah.
and in the economy. It's like, Sales. If you want to do sales, sales is the best thing ever. You know what I mean?
Yeah.
You can make
That's
unlimited
true.
amount of money, but your mind's got to be right.
Right, because you know what, Carlos, they want to teach you sales mastery before they teach you self mastery.
Mm. Mm.
You can't have sales mastery if you don't have mastery over self, right? Understanding I become what I think about. So if I'm sitting in a sales meeting and things don't seem to be going my way, and if I'm thinking, oh, here we go, this deal is blown,
Mm-hmm.
they're not going to buy. Well, guess what? You just wrote your future
Yeah.
because
Yeah.
you don't understand self, that we operate on multiple planes. So
Yes.
if I'm putting that energy out, then that's the energy that I'm going to receive back ultimately.
Yeah. Yeah.
So people want to, so like, I don't typically help people with business per se, Carlos, but I help people in its underlying core with self, which always results into better business, if that makes sense.
Yeah.
Yeah.
No, absolutely it does. It's understanding that that as soon as we put it out there verbally, our subconscious goes to work. And that's really what's driving us is our subconscious. Consciously we think we're aware, but really it's our subconscious. That's really, and
Man,
that stuff out there, that's what goes to work. So the moment I tell myself I can't do that, or that's too big for me, subconsciously everything's going to slow down, and all of a sudden
it's going
it's
to prove you right.
correct.
I, I learned from my dad. My dad always taught me, and people. I guess my dad majority did it, but people in the gym when I did gymnastics, they taught me it too. You can't ever can't be in your vocabulary.
Mm.
You know what I mean? I
Yep.
can't. Because you can. You can
Yeah.
do anything you want. You could do anything that your mind is set to do.
Yeah.
It's all
Oh
in your
God,
mind.
Yeah.
yes. And when you say mind set to do, so it was like interesting. So this week, all the major influencers were talking about the word decision, and I started studying this audio training from Bob Proctor on decision, and I realized why decision were so important. And you hear people say, decision is deciding to cut off one thing and go towards another thing. But the reason that a decision is so important is because it is a mental state of being. It is a mental state of being, and life responds to not what we hope, not what we desire, not what we wish, but it responds to who we are being. So when you make a decision or you say, I am going to move forward in this, like truly the whole universe conspires with you to bring it to pass because I've made a decision. And the thing that I've made the decision about, the provision will always show itself. Why? Because it has to, because that's the energy that I've put out.
Yep.
Yeah. Whether you think you can or you think you can't, you're right. Either way.
So powerful, no truer words ever spoken.
The decision is a great word, and I always tell people it's like you got to make a decision. You got to make decisions quick sometimes, you can't sit there and think about it and analyze it. You got to make the stuff quick. You got to make that decision. Now, I always say you might not make the right decision all the time, but you got room to fix.
Yeah.
You fix what you didn't make right.
Right.
You don't always make the right decisions, but you got to just make those decisions, and you got to let things happen. It might go great, but it might not go good. But you just shift it and you change it and you go a different direction.
Mm-hmm.
But you got to make decisions. You got to make them quick too. And I love that decision word.
Yeah.
Decision. They say you make them quick, change them slow.
Yeah.
Most people allow outward circumstances to influence their decision.
Mm-hmm.
The market the interest rates are too high. I'm slowing down. I'm not buying. The interest rates are too low. I'm slowing down. I'm not buying. This is a seller's market. I'm slowing down. I'm not buying. I'll buy when the kids get out of school. I'll buy when the husband hits 25 years and his pension is straight. It's like Bob Proctor said this. And the reason I love talking about Bob, and actually we've tapped into my ultimate passion because I have another company, which is a self-development company. I've been working in self-development space for about a decade, and I had the opportunity to actually work with Bob Proctor at his company and have him mentor me. And Bob always says the only prerequisite for making a decision is, do you want it or not? Not if you can afford it or not, but do you want it or not? And once you've made that decision to do so, the finances or whatever the circumstances and situation will find their way to you. And this is the absolute truth. This is not something I've just heard. It's something that I've experienced.
Yeah, I agree completely. I mean, listen, I don't fear making decisions. And if I make the wrong one, I make another one.
You know what I mean?
Absolutely.
You just got to keep moving forward. You know, you got to make that decision. You can't, you know, not everything goes correctly, but you can even adjust it. Even if you made the wrong decision, it might not have worked then, but you just adjust it. You know what I mean? Just adjust it to make it work right. You know,
That's right.
maybe something in that decision that you made just was off. You know, adjust it or make a different decision. But if you don't make that decision and you don't move forward, you're just going to stand still, you know?
Yeah.
Carlos, did you realize?
Go ahead, Mark. Go ahead, Mike.
No, I was just going to say, Carlos, did you know that a rocket shifts or fills its way to the moon? Like half the time it's off track, it's constantly being pulled back.
Yeah.
I didn't know that.
Yeah, it moves.
It's constantly going off track, and that reticular activating system inside of the mechanism, which we all have reticular activating systems that keep us on track. That's why no matter what, unless a person truly changes that program, let's say they've never made more than, let's say, I don't know, $100,000 a year. They've never made more than $100,000 a year, but let's say the first 6 months they just really kill it. They have a great. They are like already at like 75,000. They will slow down unbeknownst to them for 4 months until they're back at 100,000, and they don't even know what happened. But it's that reticular activating system, as Carlos said, that shift. Are you constantly pulling yourself back and reevaluating your goal? Or ultimately, the goal is the destination. So you got to fall in love. And I used to hate when people said this, but now I understand and I love it. You have to fall in love with the journey of where you're going, because you spend more time on the journey than you do at the destination.
That's
and
right.
Then how many times have you gotten to the destination and it did not meet your feeling that you thought you were going to have? Oh, okay. You know, it might have been a restaurant somebody hyped up. It could have been a vacation spot. You ever paid a lot of money going to a vacation spot? You get there, you really don't like it. It wasn't what you expected.
Not only that, but it doesn't last very long.
No, right. Not at all.
You're there for a week or two, and then you leave. You know,
right.
You're done.
Yep.
You might as well enjoy what you're doing and how you're getting there to get there.
Yeah. You might as well enjoy what you're doing and how you're getting there. That is so powerful.
Yeah. Yeah, agreed. It's like you know, when I go to the beach, I drive most of the times and enjoy the heck out of the drive. You know, there and back, just enjoy it. And you know, there's a couple times I've gone down to Florida and I've been driving at night and literally pulled over in the middle of the night and looked at the stars. You know, just
enjoying yourself.
Yeah, just looked at the stars. A nice dark night, no lights out on one of those country roads. And I was like, man, look at those stars. I pulled over and got out and looked at the stars and just took a moment to breathe, take in, enjoy the journey. You know what I mean? So
Well,
that's definitely well said.
And I notice when you're traveling, you stop and take pictures and videos and stuff in different places.
Mm-hmm. Yeah,
You know?
for sure.
And people take pictures and videos because those last longer than your mind. You know what I mean?
Yeah,
Those memories last longer. That's why there's videos and pictures.
yeah,
But you take that to enjoy, to remember what you're enjoying along the way.
that's
You
right.
know,
That's right.
even
Yeah,
if it is you're driving for work or you're flying for work, or you just traveling to 45 minutes or an hour to work. You got to enjoy life and you got to enjoy your journey.
yep. I agree completely. It's fun. This has been a good. We're over an hour, so I want to respect everyone's time, because I know Friday is a grind day for many of us, or a wind down day for some of us. So I definitely want to respect everyone's time, and let's wrap this up. But Mike, appreciate you joining us, man. I'm so glad that you were able to join us, and we're gonna have to bring you
Thank
back,
you.
because
I would love to, man.
yeah,
This is amazing.
the topics we discussed can be dug into deeper depths. You know what I mean? So we got to bring you back.
I'm
So-
just sitting here thinking about the things that we've spoke about on this call, and truly, as Carlos said, it's definitely we could break this content down into a 5-day conference, really digging into the mindset of I guess the mindset of accomplishment, you know. So I'm grateful to have been here. You've been a great mentor to me. And let me funny thing, you gotta be careful what you say, because I was telling Steve's son that, man, I would have loved to have had your dad as my dad. He's a great dad. The very next day I got on the phone, Steve yelled at me because I asked him I asked him a question that he answered already in the email. And he said to me, his whole voice changed. He said, "Look, man, I'm telling you, read the email. See, this is what happened last time." And I was like, wow, I really felt like Grant. But then the funny thing was, Steve told me he said I was just getting on Grant right before that. So like that energy just transferred right over to me. So I got my wish. So, but guess what? I've read every email since from everybody.
Right. That's right. And that's what my wife and I were talking about, learning from, you learn from your mistakes. You know what I mean? You learn from what you do. Every day you're always learning something new, and if it takes, if it takes getting, reading your emails, I'm going to start doing it, because I said something to my daughter. She's learning how to drive. Well, she got a nasty letter on her car. And it said, it said some nasty things for being, a first-time driver, but they didn't know that. But still, I said, so when you park, are you going to think of that note and do it correctly the next time? Because, she parks but the conversation was, well, that note didn't need to be done. It doesn't need to be done, but are you going to learn and change it and shift and change what you did the next time you park? You know what I mean?
Spit out the bones.
Right. So then the next couple of days later, we're coming out of a restaurant, and I said, "Bella, did you see how you parked?" I said, "That's not fixing what you're going to do." You know what I mean? I said, "You got to think about that note and not get that note again." You got to shift. You got to change that mindset. You got to change. Well, I was in a hurry. It doesn't matter. If you're in a hurry, you get out, you make sure that you're parked in those lines, because you don't want to get another note.
That's right. That's right.
You're right. It was not a pleasant note. It wasn't.
You're right. No, you're right, man. No, it's good stuff. I mean, it's, listen, that's the way we grow. You know what I mean? We grow and we learn and we adapt and we adjust. And that's what we have to teach our kids as well.
Absolutely.
That's what we have to do. I had the same conversation with Grant on something, and It's like, well, the teacher, I have a right to, do this to the teacher. I was like, you don't have any rights. You're in school. The only right you have is to show up, do your job, do your homework, take the test. That's it. You don't have any rights. That's your right. And after
That's the
that,
right.
you're done. Yeah. You don't have any rights. This is not
Right.
this is no rights there. But they learn from it. Okay, guys, we'll wrap this up. Again, appreciate it. Carlos, anything last words at all for Mr. Lowman or anyone out there?
Nope. It's good. Let's continue this on with some events. Let's continue
Yes.
this on with some more, some more online presence,
Yeah.
and let's educate. Let's educate some people. I loved it. I love this. I mean,
Yeah.
I absolutely, this is just a little bit of what everybody could get. And I want to teach and I want to educate as many people as we possibly can, because this is good.
Yeah.
I just told some of my agents, told an agent in here, I said, you need to listen to this call right before we started, right as we were starting. I said, you probably need to listen to this call.
Yeah.
Absolutely.
It's good stuff. Mike, any parting words, my friend?
Nope, just very grateful to have, been here and to be able to share and to learn, and, just looking forward to what we're going to put together, because I know Carlos is not going to let it go to the wayside.
No,
not at all.
Cool. All right. Well, guys, thanks. Enjoy the Friday, enjoy the weekend, and certainly appreciate everyone's time this morning.
My pleasure.
Enjoy.
All right, guys, have a great day.
Thanks.
Thank you.
Take
See
care.
ya.
All right.
Bye-bye.
Bye-bye.